Alright, in this video we are going to be doing vertical analysis on Kroger and Whole Foods stores. Both are a grocery chain, but the scale is really different. Kroger has, in 2016, had $115 billion of sales as opposed to $15 billion for Whole Foods. So they're very different size and they have a different business model. Whole Foods, generally speaking, is specialty, fresh type food, a little bit upscale, and Kroger is just your power chain. And Kroger might be more comparable with the Publix and the Harris Teeters of the world, and or with the Walmarts, because Walmart's primarily a grocery store. Primarily, it's more than 50% of their revenue, and Whole Foods is more of a specialty type of food store. What we'll see as we start looking through the vertical is that understanding these differences between the two firms will help explain some of the things we see in the common size income statement and balance sheet. All right, a common size income statement divides everything by revenue, so all the numbers, instead of using actual numbers, we use percent of sales. And the first thing that leaps out is that the cost of goods sold for Kroger is about 78% as opposed to about 65% for our friends over at Whole Foods. And it's come down slightly for Kroger, all right, for a $100 billion company, little, percent here, percent there, you're talking about real money. So it's 79.4, 79.4, and then we see it down to 77.8 here. That's about a 1.5 difference. And some of that might be when they were doing some acquisitions in these years, and some of it is just simply scale. So that leaves Kroger with a lower gross profit margin. Now, if you think of the cost of the goods sold, if you think of that as 100%, then the revenue would be whatever the cost of the goods sold is plus your markup. So what this doesn't mean that the cost of goods is higher for Kroger. Generally speaking, what it means is their markup is lower. They don't add a greater margin onto the cost of the goods sold. For instance, if Kroger bought $1 million worth of bananas, it might mark up that $1 million of bananas to $1.25 million. Whole Foods, on the other hand, would mark it up to $1.5 million. All right, so higher gross profit for Whole Foods. Now, the selling, general, and admin expense includes salaries and light bill and all that other good stuff. It's a lot higher for Whole Foods than it is for Kroger, and part of that is going to be business model, and part of it is economies of scale. In the end, we get to operating income, or earnings before interest and taxes. Kroger about 3%, Whole Foods currently about 5.5%, and that's down from about 6.5%. So the profitability has declined a little bit over at Whole Foods. It's pretty rock steady over here at Kroger. If we come down here to net income, the net income for Kroger was about 1.5%, and you have a little bump here in 2015, but it's still between 1.5% and 2%. And for Whole Foods, it was 4%. It's come down a little, but you can still probably count on 3.5%. And we don't know what's going to happen in 2017. That could actually come lower. All right, 4.1 down to 3.5 down to 3.2, but 3.2 might be an aberration year. All right, so it's hard to draw too many trends in here, but the profitability, net profitability for Whole Foods seems to have slipped a little bit, whereas if you're looking over here at Kroger, it's stable and or arguably it might be a little bit up. All right, but Whole Foods has a higher profitability on sales than Kroger does, and we might expect that for a company that does specialty foods and or caters to a upper scale clientele. But not a lot of difference, but the difference is there. If we go into the common size balance sheet, we see some more differences. Start out with assets. Notice that of the 100% of assets, other non-current assets is roughly the same for both firms. The net fixed assets is roughly the same for both firms in 2016. For Kroger, there's not been a lot of change. It's been roughly 60%. But for Whole Foods, it went from 40 up to 50, 55. All right. So we do see a change there. And we can also see that the current assets for Whole Foods have declined somewhat as a percent of assets. Now, that's where it starts to get a little tricky just looking at the percentages too, because now we might want to go back there and see what's going on with current assets, net fixed assets, and other non-current assets, because the mix has changed from 39, 41, 19 to 31, 55, 15. All right, so ratios tell you what you ought to go look at. They don't tell you what anything means. If we go over here and look at what's going on with our friends over here at Whole Foods, there's the total assets, which are growing. Notice that the current assets are actually getting slightly smaller. 2.1 billion, a little under 2 billion, 1.7, 1.5, and then there's a jump back up in 2016 where they go up to closer to 2 billion again. And you see the net fixed assets are actually increasing. That's the storefronts and the equipment and all. You see it's doing the same thing over at Kroger, also going up. And then looking at this mix in here, what we had was roughly 2 billion, 2 billion, 1 billion, and that's gone up to 2 billion, 3.5 billion, 1 billion. So that's the big change, is net fixed assets have grown. If we look at just 2012 to 2016, the really big difference is that those asset increases from roughly 5 billion to 6.5 billion is almost all net fixed assets. All right, so the mix has changed, and then you're getting a bigger slice of the mix is net fixed assets. These proportions, the actual number, that was about $1 billion in 2012 and about $1 billion in 2016, and current assets was $2 billion in 16 and $2 billion in 2012. Assets are growing, and most of the growth is not in net fixed assets, and that's what's causing these ratios to change. All right, so when you do ratio analysis, it ain't just about this number got bigger, this number got smaller. It's the why that matters. When we look up here into the mix in the current assets, see cash makes up a large part of the 2012 current assets, and then when we move over to we look and see like receivables are very, very small number. Interestingly enough, the inventory, Kroger's 18% of total assets are in inventory, which is more than twice as much as we see over at Whole Foods. And we tend to see the same changes. The current assets as a percent are going down. The net fixed assets as a percent of total assets, a slight decrease. The big increase is here in the other non-current assets, which we can see over here going for Kroger from roughly 2 billion, 3.5 billion, 3.7 billion, 4.4 billion, 5.2 billion. So they have been adding net fixed assets, 15, 17, 18, 20, 21. It's the rate of change in the non-current asset, other non-current assets is higher. And we can also see the difference we saw in the inventory with Kroger. Remember, their assets are roughly 6 times the assets of Whole Foods. Their inventory is more than 10 times. All right, it looks like closer to 11 or 12 times. So relatively speaking, Kroger holding more inventory. And that makes sense because if you can buy in bulk and or if you're buying canned goods that can be stored longer versus a relatively higher mix of fresh foods over at Whole Foods, Whole Foods has to replenish their inventory more often than Kroger does. So we would expect to see those numbers. As we spot down here to the common size balance sheet, the liabilities portion, notice that the accounts payable is much higher for Kroger's than it is for Whole Foods. And that might be also a reflection of buying lots of bulk assets or what have you. Might be just a size difference. It can be a lot of things. But what we do see is that they use more accounts payable per dollar of assets. And the short-term debt is also higher. There's virtually no short-term debt in Whole Foods during this whole period. But with Kroger, usually it's running roughly 6 or 7%. 2012 it was higher, don't know why. Long-term debt, about 30% roughly. And for Whole Foods, notice that it had almost no long-term debt, 1% or less, until 2016 when they borrowed $1 billion. All right, so that changed their liabilities, which were running roughly 30% or 30 to 33%, and then it jumped up to almost half. And you see over at Kroger, it's a pretty stable, right around 82%. Total liabilities to total assets. We can also see some other similarities jumping out here with the percent of assets funded with equity, which would be 100% minus the percent in total liabilities. You could see they bought back a lot of treasury stock being bought back. And that's one of the big ones we see over here with Whole Foods, is there's a big leap. They actually borrowed $1 billion up here in long-term debt, while at the same time they repurchased about $1 billion of their outstanding shares. Now, again, when you see changes in any of the numbers, it's instructive to just go back into the actual sheet and look at the dollar changes. Here we see long-term debt went from about $62 million to $1,048 million, roughly $1 billion change for Whole Foods, and the treasury stock got negativer by about $900 million. So essentially, borrowed $1 billion here, bought back $1 billion worth of stock here. What that did was change their mix of debt and equity from roughly $1.5 billion of liabilities and $4 billion of equity to about $3 billion liabilities, $3 billion of equity. So that's a pretty big change, and that you don't see that sort of change occur very often. But that's Whole Foods actually increasing their financial leverage. All right, so that's the sort of stuff we can get from these side-by-side evaluation of the common size income statement, common size balance sheet.